And the only thing I've been doing is taking your attention off that bullshit and putting it on price itself, because it's going to tell you everything you want to know. You want to know when it's going to reverse? It'll tell you that. You want to know when it's getting ready to explode and move in one direction? It'll tell you that too. You want to know when it's going to be consolidating and hard to trade and can be in choppy conditions? I've proven that it tells you that too. So pray tell, why the fuck would you want to look at anything else? Open, high, low, and close tells you everything. It tells you everything. And you don't need to look outside of it to derive a bias, a narrative, or a trade idea. When we're looking at the new week opening gaps, one of the things I've already mentioned it before, but you need to make sure you have this in your notes. The new week opening gap on trending days or trending weeks, where we're going to have a one direction railroad ride away from where we opened up, that new week opening gap is going to be little to no importance. Maybe used one time intra-week, and then it just never comes back to it again. I taught you that if we keep going back to it and gravitating to it, that confirms we're going to be in a sustained consolidation. It means that the market's not likely to do what? Have these big tear-off runs. I've explained that to you this week beforehand. Before it did what your chart shows right now, I told you that we will be in a consolidation. I took you through the daily chart and I told you, look where we're at. We're in this range. Well, was also some qualifying things that helped support that narrative of why I was confident in telling you that. Because we had two volume imbalances on the daily chart inside that small little range. You know, the same volume imbalance I told you in the February 12th review on YouTube before the week even opened up. I told you, have them on your charts and extend them through the entirety of the week. I'll touch on that a little bit later in this discussion, but new week opening gap is fair value. It's a static value between the opening price on Sunday and the closing price on Friday and the midpoint of that, which is consequent encroachment. Those three specific price levels are going to be very, very sensitive throughout the spectrum of a trading week if it's going to be range bound. So you see people saying, I don't do very well in trending markets. And they'll say, I do very, very well in consolidating, choppy markets. Okay. And you see other people say, I can't do good in choppy consolidations. I like trending markets. Okay. I have something for all of you. My toys, they play in every market profile, every single one of them, which is why I teach market profiles, not market profile like you think. Market profiles or templates, think of them as schematics on what the market should do conceptually on a line basis. Okay. We're going to talk about that too. Because the market tends to do these types of things with a greater sense of repetitiveness and transparency. It many times telegraphs it's going to be doing these very things, and you simply have to align your expectations and then wait for the time of day of week for it to occur. What do you mean by that? It's too ambiguous. It's too vague, Michael. Think about what I gave you in my analysis throughout this week, in the live sessions, in the reviews, and in the pre-market analysis before Sunday even opened. I said that we're going to be likely to see a risk-off scenario. Risk-off means dollar index is higher. All other markets are lower. So that if you haven't done this yet in your notes, risk off, dollar higher, markets lower. Risk on, dollar lower, markets higher. What do you mean markets higher? Anything other than dollar. Yen, pound, gold, oil, equities, index futures. Notice I didn't say crypto. I don't know, man. Don't ask me about crypto. Okay, I'm clueless. I have no idea. But every other market will be pressured. If you want to talk about buying and selling, pressure that exists between the mechanism between risk on and risk off. If the dollar's going higher, it's going to be very easy for other markets to drop, and your sell models can be trusted. Your institutional order flow, when it's bearish, can be trusted. Your premium arrays can be trusted. But if the dollar index is consolidating and it's stuck, that's going to be seen in other markets too. It doesn't mean that all markets in that condition will be stagnant and consolidating. It just means that that's the expectation you should hold. But within that, that tells you a story. What is that, Michael? What are you getting at, man? Lean in real close. If we have a range bound consolidation in dollar index, in Forex, you can look at the relationship between pairs like euro pound, because the dollar index is being held. It doesn't mean that every foreign exchange market or pair is going to be consolidating. It just means now, when dollars being held in consolidation, the crosses like euro pound, Aussie yen, pound yen, those exotic crosses will be manipulated, and you'll see the runs occur in those markets versus the dollar pairs. My techniques work in every market profile. The problem is you're not spending enough time looking at what market profile we are in. And I'm telling you where we're at before we even start trading. Let's go back to the 12th of February. Before the market opened up, I stated that I believe that the dollar is going to go higher. I believe still that the dollar is likely to trade up into those relative equal highs that I have shaded in orange. There's buy side resting up there. Unless we see something completely undermine that expectation this week, I'm holding true to that. The dollar expanded higher interweek. We're not trying to predict the closing price on the week. I'm not trying to teach you or have your focus on knowing where that closing price is on the weekly candle. That's not what your job is, not to do that. Your job is to anticipate the market gravitating towards a direction on that weekly chart, expanding higher on dollar and expanding lower on other markets. But the problem here is within your measuring of that tape that's going to be delivered over the day, over the course of the week, you have to consider also we are stuck in that range on the daily chart since essentially the first trading days of February. We're stuck in a range bound environment. So when I give you that bias that I think is risk off, we're going to see what kind of market profile. Consolidation with Thursday or Friday expansion. Go back and look at the core content. Look at day trading section of the core content. For those that are really versed in keeping good notes with my concepts, or if you're a charter member and you know exactly what lessons and where to find it, what month should they look for the daily and weekly templates, those profiles that I teach in my core content. That's already on my YouTube channel, so you don't have to ask me for it. It's a consolidation week with or Thursday or Friday expansion. Now think about what I've taught to you about on Sunday. Higher dollar, but we're in a consolidation. So we have to wait for something to occur. It's going to be consolidation. Yeah. It's going to be choppy. Yes. Is it tradable? Yes, absolutely. I traded, other people traded it. It's fine. But we are considering this big event coming into Tuesday, which was the CPI number. It's interesting, isn't it? Now, You see these folks out here, they're out here constantly running numbers. They're crunching numbers. There's a certain guru, and they're talking about me. There's a certain guru out there that says that when the markets make the high of the week or the low of the week, he says it's 70% of the time it's on a Tuesday. Yeah. Yeah. It's not an every week profile that delivers a bias higher or lower. Sometimes there's weeks where it's expected to do nothing but go sideways. You can't factor that because if you do that, then you skew your output. And numbers, like anything, if you torture them enough, they're going to confess to anything. That's what indicators do. They whip and torture data that's already happened that you can't make money on. And if you tinker with them long enough, the indicator will tell you what you want it to say. And I was victim to that. And that's all these authors ever do. They take something to form fit something that's worked in the chart in the hindsight. They did not do that shit live. Now you see me walking you forward on a 1 minute candle basis, calling every fucking candle exactly how it's going to happen. Now, there's no indicator in that. There's no retail thing that I'm leaning to. I'm talking about the candle that's forming based on the stuff that I talked about on Sunday before the market opened up. We're in range bound. We're expecting a move in the dollar. We're expecting weakness in other markets. But does it happen right from Jump Street? Does it happen, well, it's just going to be a straight decline? No, we have to be navigating through consolidating and choppiness. Looking for areas of what? Fair value. Well, what am I supposed to focus on, Michael? There's two volume imbalances I told you to focus on from the daily chart on the ES. Told you to take those levels. In fact, you want to go back through that February 12th, and there's a lot of key levels I talk about. I'll mention them in here for those that are lazy, but there's specific ones in there that I talk about, and it basically framed the whole entire week. Now, I leave that for those students when they see me talk about it, they have them on their charts. And then when they watch the end of the week, when it comes to conclusion, and they see, wow, the market did go up to that level. Wow, the market did go down to that level, and it didn't do anything else. That's real harmonic. That's the wave Elliott wants to ride on, right? He wants to hang 10 on that wave. Well, if you go through the market review on the February 12th, you're hearing me talk about how we're expecting, and I'm expecting specifically the expansion higher on dollar. So that means it's going to be easy to find what? The sharp, big magnitude moves are going to be in what direction in ES? Down. It doesn't mean that you're not going to have rallies that are tradable that look decent when you're on a 1 or 5 minute basis. It's going to look dynamic because you're zeroed in. You only have 3 candles on 1 minute candlestick chart. You're so zoomed in. You got to take some space and crunch it up and put more data on there. But you're going to see that these big sharp declines that we've seen in ES are in concert with what we were expecting on Sunday before the market even opened up. The market's going to gyrate back and forth all day, all week, that's going to happen, yes. But you want to know where there's conditions that's going to present range bound, difficult times where we don't see these big trending days. Trending days are easy to trade in, and you don't have a whole lot of opportunities to get in. It's just, here's where you got to know to do it this, and if it starts running after that, it's over. You've missed it. You got to wait now for the next opportunity. But in range bound consolidations like we're in right now, you have to be nimble. Pick your shots. When it gets to your levels, you get out. Don't think that we're going to keep on tearing off higher or tearing off lower. It's going to be within a predetermined range. So what's the weekly profile? We'll go back and listen to the 12th of February. I tell you, it's going to be risk off, dollar higher, markets lower. So now let's take that one step further, Michael. Let's put further scrutiny behind all the things you said before. So what you're saying essentially is the market's going to go sideways, yes, but this has a lower tone behind that for markets being bearish and dollar higher. So while within all the context of a range-bound market over the course of the entirety of the week, we're essentially going to see the biggest move with the magnitude and speed that we like to look for as price action signatures is going to be in the expansion higher for dollar and lower for S&P, lower for euro, lower for cable, lower for all other assets. Okay, so if that's what we're expecting, overall, if you take a step back and pull up a 15-minute time frame on any of your markets that you'd like to follow, we had what staring at us in the face on Tuesday? CPI. That was the big. It was the elephant in the room, or in this case, it was the bull in the china shop. It just went in there and wrecked everything. But did it do what it was designed to do? Let's take a closer look at that. On Tuesday, all of this was behind the backdrop of CPI, which is what mechanism? Manipulation. You're not trying to predict anything except for the volatility that's coming into the marketplace. Do not have high expectations on knowing anything specific about any key level holding this or that, because CPI, FOMC, rate announcements, they can sometimes literally destroy even my best analysis concepts because it's manual intervention. Manual intervention is within the scope of what I mentioned earlier at the beginning of this discussion, which is a black swan. You don't know when they're going to manually intervene. You don't know that. You don't know when a bank is going to come out and say, yeah, we're just going to do a surprise interest rate cut or hike. Oh, what? You don't think they can't do it? They can. They can go out and devalue a currency overnight. Boom, gone. That's always risk. And we know that when we first come into this business. We're welcoming that uncertainty, and you need to. Doesn't mean we want to see it happen, but you say, as a trader, it's not likely to happen, but guess what? Shit happens. But if we're expecting consolidation, through all that consolidation, ultimately, the largest magnitude move is going to be dollar higher, all other markets lower. Oh, well, if we look at the profiles that I teach and taught in 2017, that's when those videos were produced, the summer months of 2017. Now, that logic was with me in 1996, but I put it into students' hands in 2017. They're in those core concept modules and lectures on my YouTube channel. So we have a range-bound consolidation week with a Thursday or Friday expansion. Okay. What would that look like based on what I gave you on Sunday? A range-bound market. If we're going lower, so that means for S&P, if we're going lower, because we're expecting risk off, that means the dollar's going to go higher. That means on Tuesday, CPI should do some kind of manipulation and create what for the dollar on Tuesday, the low of the week. What should that mean for S&P and Forex? It should be making what? The high of the week. Okay. When should the new move occur? Because if we don't trade the manipulation, we're waiting for what to occur? Thursday and Friday's expansion, lower for S&P and higher for what? Dollar. Look at your charts. Did it do it? Yes. Let's go further. Let's look at the Tuesday high. What's some observations there? Well, February 3rd of 2023, the daily wick consequent encouragement, it's a premium wick. Okay, if you look at that, Tuesday's high just goes like 1 point, maybe a point and a quarter past that consequent encouragement of February 3rd, daily wick. So the wick above that daily high on the 3rd of February, split that in half. Look at your high on Tuesday. Well, that's random. It also swept February 9th buy-side liquidity. And it was all manipulated by what? CPI. Okay, let's flip it. Let's look at the other side of the weekly range. The low of the week, look at January 30th, 2023. That candle, mean threshold, it's a bullish order block. The level actually is 40.57 3/4. So 4057.75. Just happens to be a level I've already talked about. Told you to have it in your chart. It purged the daily low on February 10th of 2023, which that low comes in at 4060.75. Incidentally, the only discount array that I mentioned on the February 12th commentary was the 1st of February, discount consequent encroachment, 4067.25. So inside that range, that weekly range, what was the factors that you should have been paying close attention to? Go back to the daily chart. What did I talk about on the 12th of February? I said there's 2 volume imbalances there. You want to extend them throughout the entirety of the week, all the way through Friday. But Michael, I got all this shit on my chart. How am I supposed to see price? You're supposed to have different templates to do certain things. New week opening gaps, you're going to need a template just for that. You're going to have 5 of them on your chart at any one time. And if they're in close proximity to one another, it's going to be a lot on your chart. And then you're going to add what? You're going to add all your rectangles for fair value gaps. You'll have too many things. This is the reason why I use a notepad. I don't have all that shit on my charts. I have it in my notes. But you, as a student learning this, you'll have to do what I did. How I did it was I had charts that I only kept for certain functions. The primary function for the new week opening gap, I have a chart that just simply has that on it. I have nothing else on it. And I refer to that intraday, intra-week. Whenever I need to reference something, if I want to check my notes, maybe I wrote a number down wrong. Maybe I didn't annotate a specific level correctly. I'm constantly referring back. Okay, I'm making sure I'm double calibrating every one of my notes that this is exactly what it is. And I'm watching to see if price gravitates towards these new week opening gaps. The one you're in right now that starts tomorrow evening and Sunday, that's one. And then you're going to use last week's new week opening gap, the week before that, the week before that, and the week before that. There's 5 always on that chart. It doesn't mean you're limited to just that, but you have to have at least the last 5. Why? Because I've taught that you're going to see that overlap of every month, that shift in money flow that comes into the marketplace. By having those last rolling 4 and the one you're presently working with, you won't be surprised by anything. You'll see how it's gravitating towards it and gravitating away from it. And because if it hangs around that new week opening gap, we're in consolidation. When it moves sharply away from it, and your analysis is already calling for a big trending event, then you know you have confirmation. The thing that everybody's looking for with indicators. You don't need it. It's going to tell you in price. So if you look at the range of the weekly high and low, what was taking place throughout the entirety of the week? Pull up a 15-minute time frame with those daily volume imbalances. You don't know which ones I'm talking about? Watch the 12th of February's analysis. When it gets to the S&P, you'll see I don't draw them on the chart for you. I tell you where they are. And then you draw them out. Usually I just draw it with a rectangle and extend it through. I will show you on Monday. I'm not going to be trading on Monday. It's a bank holiday, and it will be a pre-recorded lecture. So that's when you'll see my next I guess, soiree with talking about the markets. So there won't be a live session on Monday. There won't be anything except for a pre-recorded lecture that I'll probably do sometime in the morning. I'll have it up by hopefully 1 o'clock in the afternoon. And that's the next installment for the mentorship here. But before I show you that, I want you to take a look at your own chart and show where that volume imbalances are. There's two of them. Extend them through your chart and look at it over the course of the entire week with a 15-minute time frame. What observations do you see there? Notice all of the intra-day and intra-week imbalances all cluster within those two volume imbalances on the daily chart. See how that's creating a lot more of what we've seen on the daily chart. Just spotty price action. Spotty meaning it's creating these little inefficiencies or gaps created at the new day opening. You can really appreciate it if you have your 15-minute time frame chart showing those two daily volume imbalances that I referred to in the February 12th, 2023. See, this type of lecture here, for some of you, it's just like, I can't follow this because you're lazy. You didn't write down and draw into your charts the things I'm talking about when I do the analysis. You're not even doing it right. And this is exactly what happened when I had paid students. Paid students, I would sit down and tell them exactly what I just told everybody for free, openly and publicly. They didn't take notes. They didn't record the levels in their charts. They didn't stay with the bias I was giving them. They were doing opposite to that. And they bitch and complain, say it's a scam, and they run off and quit. That's on you. That's not what I've taught. And you're doing the very opposite of whatever it is I'm telling you to do. And your results are going to be what? Fucked. So don't do that. So if you take that 15-minute time frame and you have those daily volume imbalances, I annotate and show you exactly with my cursor. I'm not drawing them on my chart because I want you to do them on yours. If you want to use horizontal trend lines to annotate the volume imbalance, okay. If you want to use the rectangle, okay, it's a preference. Your annotation style is going to be your annotation style. Your colors, all that stuff, it's going to be yours. Don't try to mimic everything or use my charts. You're not going to learn the same. You'll learn to do it by doing it yourself. But if you take your 15-minute time frame, show the entirety of Sunday's opening to Friday's close, that's how much range of price data you have to have on your chart. Have those daily volume imbalances highlighted on your 15-minute time frame, and then toggle in the lower right-hand corner on TradingView. Go from, it usually will be toggled by default with ETH, which is electronic trading hours. You want to toggle that and switch it to RTH, regular trading hours. And when you toggle that, you're going to see all the new day gap more or less converge within those two volume imbalances majority of the week. You're seeing visually why markets consolidate. What's the mechanism behind why they are consolidating? It's creating these gaps, these inefficiencies that has to keep coming back to reprice to, because there is no overwhelming pool of liquidity above or below the marketplace to inspire price to go outside of it. There's too many of them near term all around in this big cluster that's being shown on the daily chart for the entire time we've been trading in February. So there's no reason for price to go explore outside that boundary yet. Why? Because they're holding price where it's at right now. It's at a point where it can go either direction, which is why I said we're going to have a consolidation market. It can go higher and it can go lower. That's 50-50, right? On a higher time frame basis, it's 50-50, yes. But on an intraday and an intra-week basis, we can still frame a bias. I gave it to you on Sunday. We're going to range bound, yes, but I do believe that the dollar is going to expand higher and S&P and foreign currencies and other markets will go lower. all of those imbalances throughout the entirety of the week that you can be seen on regular trading hours on a 15-minute basis, all are occurring within those two daily volume imbalances. Let's go one step further. It looks like a mess, doesn't it? I mean, look at your chart right now if you've done what I just asked you to do. It's like, man, look at this mess. How could anybody decipher any of this? This is just madness. It's chaos. I'm at my wit's end, Michael. This is too much now. It's just, I can't see anything in all this. Go into Thursday. Okay, on your 15-minute time frame, make sure your charts are toggled to regular trading hours now. That way you can see that gap lower on Thursday that I talked about how we were going to trade back up into. And I said that we were not likely to trade all the way back up to the previous closing price. On your 15-minute time frame, while regular trading hours is toggled, not electronic trading hours. And again, you toggle that on TradingView in the lower right-hand corner. If you look at the Thursday gap, we gap lower. Look at the bearish breaker that can be seen on Wednesday, February 15th. And if you're using a 15-minute candlestick chart, the time candle is going to be 14:45. And your chart must be set to New York time. If you're doing anything other than, if you're looking at in your local time, you're not going to find what I'm talking about. Everything that I teach, your charts in TradingView must be New York local time. But if you look at the February 15th, which is Wednesday's bearish breaker on a 15-minute candle, the candle itself is at the timestamp of 14:45. Notice that how price, when it came back up into the gap that was formed at the New York session opening gap at 9:30, the difference is where we traded and closed the previous session, and we're at 9:30 opening. You're going to be doing this every day as a day trader in index futures. You do this every single day. You're going to toggle real trading hours from electronic trading hours, because that gap, the difference between the previous session close and the new session opening at 9:30. Yes, we traded all night long. Yes, it's really going on. It's being traded back and forth. Yes, but the premium or discount of that gap relative to where we closed the previous session. What I mean by that? Are you talking about the PDA rate matrix? No. The term is we're opening up with a premium if the gap is higher than previous session close. We're opening at a discount if it's lower than we were closed in the previous session. So on Thursday, we opened where? Down. We were in a deep, deep discount. So it trades up to what? The previous session closed? No, it doesn't need to. Well, how do you know when it's not going to do that, Michael? 15-minute time frame, bearish breaker, 14:45 candle, February 15th. Okay, note that. Also, if you've done what I told you to do by taking that volume imbalance and extending it through the entirety of the week, on your 15-minute candlestick on February 16th, the candle 12:45. Okay, so 12:45 candle on a 15-minute time frame. That high tick is the high tick of your daily volume imbalance. At 14:30, that high, the 14:30 high, is the high tick of that candle, and it's also the high tick of that daily volume imbalance. What happened after that? Free fall. Nothing's random. There is no chaos. It just looks unfamiliar right now. Everything I told you on the 12th in terms of key levels, what to look for, what to watch, it's in your chart right now. The method of how price would deliver over the entirety of the week is exactly what your chart shows right now. Dollar went higher. Markets went lower. We had to deal and contend with what? Consolidation. CPI did the very manipulation that sets the tone for what? If it's going to be a consolidation with a lower market and higher dollar, that means in simplest terms, Tuesday's the event with with manipulation, and then it's going to be providing what? Tuesday low of the week for dollar, Tuesday high of the week for other markets. Thumb in the eye to all these number crunchers. Oh, it's not true what he says. No, it's absolutely fucking true what I say. I'm out here walking it. I'm proving it to you. You're looking at it. I'm calling it in every 1 minute candle that you can't fake it. There's no way of faking that. And you're seeing how wonderfully predictable price can be. Not all the time. Not all the time. There's certain things we have to wait for.